what exactly about the job that Jay Powell has done is not up to measure? The labor market is holding up well. Inflation has not reared its ugly head. I mean, it's above the 2% target, but it hasn't blown up just yet. Where do you see the economy failing under Jay Powell's leadership?
It's great to be with you. Yeah, if you look at Jay Powell's tenure, I mean, we do have to remember that it's under his watch that we saw 40-year high inflation. They were way too late to recognizing the inherently inflationary impact of the Biden administration's economic policy. They waited too long to start raising interest rates to offset some of the inflationary pressure that it was going to create. And then juxtapose that to now, where we're putting in place supply-side benefits to the economy through the president's signing of the One Big Beautiful Bill a couple of weeks ago, all of the deregulatory activity we're engaged in. We see the inflation numbers coming in below expectations, and yet, as the president said, we have not seen the Fed come in and commensurately cut rates, and now we've got one of the highest interest rates compared to our peer nations. So he was too late to raise rates when the Biden administration's economic policies were inherently inflationary, and he's been too slow to cut rates now that we are putting in place supply-side economic policies that should be bringing down price pressures.
And of course, Scott Bessent, the Treasury Secretary, has weighed in as well, saying that there's nothing he sees that indicates Jay Powell should step down right now. But he also added that if Powell wants to see that through, he wants to see through his term, he should be able to do that. And if he wants to leave, he should as well. How do you interpret that? I had trouble understanding what he was saying there.
I mean, ultimately, it is the decision of the Federal Reserve Chairman as to whether or not he steps down or not. But I think the most important thing that the Secretary called for is that the Fed really should undertake a review of its practices. So it engages regularly in a monetary policy review, but the Fed's mission creep has extended beyond monetary policy, and there has not been a review of the extent to which they have succeeded or failed at some of the other activities that they are responsible for. And so if you look at the bank failures that we had over the last couple of years, where was the Fed in terms of its supervisory activity? We have got this building that's being built, and we've got thousands of economists over there, and it's questionable what service the American people is realizing from them. And so I think what the Secretary has come out and said is that there are 8 months left in his chairmanship. If he wants to serve it out, the president has said he can do so, but that does not absolve the chairman from doing a full review of what has happened under his watch to make sure that we're reviewing whether the Fed is appropriately stewarding their portion of this economy.
Let's talk just firmly about monetary policy and what you believe should happen there, because I believe just today alone, President Donald Trump said that he thinks that interest rates should be at 1%. You take a look at the effective Fed fund rate right now, it's at 4.33%. So that would certainly be a dramatic move. And when you take a look at the state of this economy, where we stand, I mean, do you think, in your opinion, does 1% look reasonable from where you're sitting?
When I look at the data out there and the progress that this administration is making to relax any inflationary pressures, it seems like the interest rate environment that the Fed has should be reevaluated and come down significantly. Now, again, I'm not going to say, I'm not a member of the Federal Reserve, so I'm not going to say where interest rates ought to be. But if you look at the data, inflation is coming in below expectations. We recently hit a 4-year low on inflation. We're putting in place certainty on taxes. We are deregulating the economy. We are signing great trade deals. We had 2 of them announced today. And so the president's full implementation of the president's economic plan is inherently disinflationary, and yet the Fed keeps rates at the high levels that they're at. Arguably, there is enormous room for the Fed to come in and cut rates.
Well, we have that next Fed meeting coming up just 8 days from now, next Wednesday. I don't think the market is anticipating a rate cut there, but crazier things have happened. I do want to talk a little bit about trade, because Treasury Secretary Bessent, of course, is meeting his Chinese counterparts in Sweden next week. What are the expectations for those talks? What would you expect to be discussed there?
I anticipate that the Secretary is going to continue to make progress on the terms of a final deal. So there is continuing discussion about access to markets, about opening up the Chinese markets, issues associated with their activities on rare earths and the export controls that they have put in, and of course also the ultimate tariff rate. So there is enormous space for us to talk about what for decades has been practices by the Chinese government that give them unfair advantages in the global marketplace, and that this president in his first term said that we are going to finally address. And I anticipate that the secretary is going to make significant progress when he meets with his counterpart next week in order to have discussions about getting towards a final deal.
The Treasury Secretary also said that the discussion may broaden out to Chinese purchases of Russian and Iranian oil as well. What sense do you have that Beijing is ready to discuss those issues with Washington?
I mean, as you know, the president has said that the war in Ukraine never should have started, that we need to put pressure on the Russians in order to bring an end to that. And that means upping our pressure, using our sanctions authority and our conversations with our international partners to reduce the flow of funds that are going into Russia. Simultaneously, we are still looking for the Iranians to curtail and end their nuclear weapons program. And in that case, we are going to continue applying maximum pressure on them. And in both cases, it largely is China that is purchasing sanctioned oil from the Iranians and the Russians. And so we are continuing to ask the Chinese to do their part to see that those countries not be able to fund their aggression through these oil sales that the Chinese are purchasing.
And what is the worry that if you press Beijing too hard, that China will begin withholding exports of those rare earth magnets and other crucial raw materials as they've done in the past? They could slow walk it again, because that's a big issue and it's finally starting to come through again.
I think what the secretary is going to do is just have a comprehensive discussion about all of these issues and identify where we can strike the right balance with China in order to, again, address this persistent trade deficit and also elicit their cooperation in addressing some of these geopolitical conflicts with Russia and with Iran.
I do want to talk about a social media post that came from Treasury Secretary Bessent earlier, talking about this Capex comeback that the administration sees underway. And I thought it was an interesting time for that tweet or post on social media, rather, given that we are really entering the thick of earnings season. So according to your data, I mean, you take a look at this gain that we're seeing in the first quarter, as you say, strongest back-to-back growth since 1997. But you take a look at some of the commentary that is coming out of these earnings calls, and there's still a lot of uncertainty out there. You think about companies trying to plan for Capex, trying to plan for headcount investments and the like, and it's hard to make policy and make decisions when the tariff stance can change week to week or sometimes day to day. And I just wonder if you're hearing any of that feedback when you have conversations with corporations.
So again, when we look at the data, we see that investments in capital equipment are increasing significantly, and we attribute that to the fact that we just provided enormous tax incentives to engage in new capital investments. So whether it's taking equipment expensing back up to 100%, or it's taking new factory purchases likewise to 100% expensing for the next 4 years, both of those are going to stimulate investment, whether it's R&D tax credits, whether it's the deregulatory activity we're engaged in. If you think about the fundamental shift we took in artificial intelligence, in digital assets, in energy, all of these things are inherently pro-domestic production, and that's why we're seeing this enormous response by businesses in increasing their capital investment well above where it had previously been, and as you said, hitting levels in growth not seen since 1997. So every day we are resolving some of these ongoing decades-long trade issues, but at the same time we're creating enormous incentives for domestic investment because of the deregulatory and tax agenda that this president has led.
What is your confidence that that Capex is going to lead to reshoring manufacturing in the U.S. with jobs for people as opposed to reshoring manufacturing using robots?
So whether we reshore, we are anticipating that whether the job creation is going to come from the building of the factories, the building of the equipment, and those factories are still going to need people inside them. And so, you know, if you're bringing back a manufacturing activity from abroad and you're bringing it to the United States, you know, irrespective of how much of that manufacturing is done by robots and automation versus how much of it is done by people, there are still incremental people that are being employed, and there is incremental economic activity that is occurring that is to the benefit of the American people. So we are looking forward to generating an enormous renaissance in capital investment and the industrial base here in the United States. And we do recognize that through artificial intelligence, through automation, there is enormous opportunity for productivity gains, and that the skilled labor that is going to be employed in these facilities is going to be high-wage opportunities for everyday Americans.